So again, tonight we're going to be learning the basics of Japanese candlesticks, and our class is sponsored by Alvexo and investing.com. Now, Alvexo is a leading provider of CFD and Forex trading, and they are a regulated provider, and they offer you many different opportunities when you trade on their platform. Now, tonight's class is being recorded, and if you want, you can access a recorded version of this class by using the same link you used to come to tonight's class, or you can check with investing.com under education and webinars on demand, and they'll have it uploaded there so you can see all of their classes in a short time. Now, because Alvexo is a regulated provider, I have to give you a risk warning. So let me read it and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, candlesticks have been around for a very, very, very long time. And until we developed computerized trading and computerized charting, they weren't, and online trading, of course, they weren't as popular as they are today. Even though they're well established and been around a long time, it took a lot of work back in the old days when we hand charted to draw these candlesticks on a chart. And if you were tracking 10 and 15 assets and doing it by hand, because back in the old days, that's when I first started trading. Well, most of the years, 20 years I traded, we did all of our charting ourselves. You sat there and got the prices and you drew them on your charts, and then you analyzed your charts. Today, with everything being on computers, it makes it more desirable by online traders. So candlesticks have become a very popular trading method in the online arena. And that's great because they're a very reliable charting source and a very reliable trading strategy when you understand how to use and read candlesticks. Because most people see a candlestick chart and they see lots of red and greens, and they just make this assumption that red is down and green is up. So when they see lots of green, psychologically, they just think, I should be trading it to go up. And they see lots of red and they think they should be trading it to go down. But Japanese candlesticks have very little to do with the red and the green. They're more about the size and shape of the body and how that candlestick relates to the previous candlestick and the next candlestick and the patterns that it makes. Now, there's no way into one class tonight you're going to learn all about candlesticks. So there are several handouts available for you on your screen that you can just download to your computer that will show you the most popular candlesticks and explain all this to you. Now, we're going to try to do this in class, but there's only so much we can cover. Now, each candlestick that's put on a chart represents all the price movement in that period. Whether you're looking at a 15-minute chart, then a candlestick is placed every 15 minutes on a chart. If you're looking at a one-day chart, it encompasses the entire trading of the one day. Now, to draw the candlestick on the chart, you simply put a line across at the opening price when that period started, and you put a line across at the closing period when that period ended. So if you're using a 1 hour chart, at the beginning of the hour, you put a line across, and at the end of the hour, you put a line across. You put a dot at the highest point that asset reached during that period, and a dot for the lowest price it reached. You then connect the dots to the lines, and you connect the two lines you had drawn on the open to close together, and you form what's called the body of the candlestick. This is known as the body, and these are the wicks of the candles. These are sometimes referred to as the shadows. Now, if you stepped up from the open to the close, that would become in today's candlesticks, it would be considered a green candle. If you step down from the open to the close, that would be a red candlestick. Now, the two colors that we use today are red and green. A lot of literature you read will talk about candles being black and white because, again, back in the old days, nobody had time to draw by hand red and green candlesticks. So you would draw your candlestick and leave it white if it was a bullish period, and you would just use the side of your pencil and fill it in if it was a bearish period. So a black candle is equal to a red candle today, and a white candle, which is really an unfilled in candlestick, is equal to a green candle today. So a lot of literature you talk about, and actually a lot of names of the patterns, like 3 black crows or 3 white soldiers could be 3 green soldiers and 3 red crows. Okay. But they're back from the black and white days. So this is all the information that is contained in that candlestick. Now, it's very similar to a bar chart because it's got the open, the high, the low, and the close. The OHLC, which is the same exact numbers that make up the bar chart. The difference is really the body that you're filling in and coloring in. Now, these bodies, again, because we're human beings, we react to the reds and greens. But to be honest with you, you could use pink and purple, orange and chartreuse. As long as you knew which one was bullish and which one was bearish, as long as you understood them, that's all that makes a difference. Now, candlesticks are more about the shape and the size. Very little to do with the reds and the greens or the blacks and the red, or the abundance of those colors. Now, they do tell you the story of the battle of the bulls and the bears, the buyers and the sellers. And there are 6 main shapes that we can talk about. Okay. The first is a bullish candle with a fairly normal sized body, which could be a medium to a large body, and fairly equally, say, wicks on either side. This tells you that the bulls were in control of most of the period, and they maintained their strength, but they were pushed a little bit higher, but weren't able to sustain that high. But they dominated that period, where the candle number 2 is the exact opposite. The bears controlled or dominated that period. 3, 4, 5, and 6 are all relatively the same. Okay. They are small body candles. Okay. Whenever the body gets smaller, that means the distance between the open and the close are very small, means they are indecisiveness. Okay. That the buyers or the sellers are not in control in that period. They are indistinguishable. Now you see some that have long shadows and some that have short shadows. So the shadows going down tell you that the sellers at some time were able to push the price down, but weren't able to hold on to it. So if you imagine as a tug of war, and so at one point, the guys on the right-hand side or the guys on the north side of the river dominated for a second. They got a big tug in, but the other side pulled back and they ended up fairly equal at the end. Nothing changed anything. So they're basically indecisiveness. They're showing that nobody's controlling the market. But now we go from there to specific types of candles or specific shapes of candles. One of the most well-known ones is called the Marabuzu. Now, can you tell me something you're seeing on your screen about the Marabuzu that's different than the other candlesticks that we were looking at? The Marabuzu has no wicks. So what does that tell you? When you have the green Marabuzu and it's got no wicks, it's got no high and no low. That means from the beginning of that session, whether it's the 1 hour or the 1 day, that the bulls controlled everything. The bears never got the pull down, and at the end of that session, the bulls had pushed that price to the highest level it had been. So you would expect the next session to open with the same momentum that ended this session because they were all running full force and in control. So you have the bullish Marubozu and the bearish Marubozu. You usually see these appear in the opposite trend. So in other words, in a downtrend and a bullish Marubozu appears, it's telling you that downtrend is over and we're moving into the beginnings of an uptrend. When it appears in a downtrend, it appears in a sideways action or an uptrend, it's telling you that action is over and we're moving into a downtrend, and usually a very strong downtrend or uptrend when you have a Marubozu. Then we also have spinning tops. Now, spinning tops look like the candles that we saw, the indecisiveness. But candlesticks with long upper shadows and long lower shadows and a small real body are called spinning tops. One shadow represents the reversal of sorts. Spinning tops represent indecision. The small real body shows little movement from open to close, and the shadows indicate that both the bulls and the bears were active during the session. And then the most common pattern, and the one that we watch for and you'll hear about all the time, is the doji. The doji is a complete sense of indecision. If you notice, there's no body to the doji in the candle on the left. That means the open and the close were the exact same price. And there was little action going up or down. Now, back in the old days, when the markets moved very slow, and especially when we have basically the stock market, and prices, were moving very small amounts, a doji rule of thumb was the open and the close had to be exactly the same. So it was just the line. Because when we apply this to CFD and especially Forex trading, we're trading in very volatile markets with high liquidity, and prices, in Forex is a pip. It's a thousandth of a point. So to get an asset to close exactly where it opened, a thousandth of a point over, that means the euro is at 13652, and it closed at 13652. Exactly, it's very difficult because it closed at 13653. Well, so the interpretation for a doji now is that the open and the close have to be virtually the same, almost the same. So you can either have a little tiny bar or no bar at all. No bar at all is usually the stock market. Now, the thing about dojis, Marubozus, and spinning tops is we always have to look at where they appear in relationship to the current trend. Just because they appear doesn't mean anything. You have to look and see whether the market's an uptrend or a downtrend or sideways congestion. And a doji, especially, the relative of doji depends on the preceding trend and the preceding candlestick. After an advance or a long white candle, a doji signals that the buying pressure is starting to weaken. After a decline or a long black candlestick, the doji signals selling pressure is starting to diminish. Dojis indicate that the forces of supply and demand are becoming more evenly matched. So it's always important to look out for a doji in relationship to the trend and where it stands, and they become more significant by their placement. Now, before turning to the single candle, from the single candles to multiple candlestick patterns, there are a few general guidelines we should cover. So now that you have a basic idea of what candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple, uncomplicated patterns. Now, again, these are all in the handouts I gave you. You don't have to remember the names. You have to remember what they're trying to tell you, because candlestick patterns appear quite often. During a trading day, you've got a candlestick for every time segment you're looking at. So these patterns do appear quite often. It's how much you're chasing them. What effort are you going to put into them? How much they're trying to tell you. But these are fairly common and quite likely to appear for you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately can make the difference between a winning and a losing trade. So we want to talk about positions. Now, the most popular one is called the star position. A star position is simply a visual representation. It can be a doji, it can be a hammer, shooting star, spinning tops. It means that you have this small candle with equal size shadows that appears, especially in an uptrend after a white candle, that it looks like it's in a star position above the candle. It really can't be because the open and close have to be the same, but it visually looks like it's in a star position, or the reverse in a black candle. Now, we have shooting stars, we have inverted hammers, we have all these kind of hanging men. They're all basically the same candle, just depending on the wicks that we talked about earlier. Sometimes you can have a long wick down where the bears had a little bit of domination. Sometimes you can have a big wick up where the bulls had domination, but it still ended up with a little bit of move in the body. But whether it's a hammer or a hanging man, we have doji gravestones, we have a gravestone, we have all kinds. It's really the body of the candle and then the interpretation based on the wick. But it's more important to see where they are in the trend. Now, there's no hard, fast rule about what color one has to be and whether it's got to be a hammer or a hanging man. It's where it appears in the trend. If the prices are moving up and all of a sudden you get this something of indecision, it's giving you a warning. If you get the indecision and it's got a long body, a long wick in the opposite direction, it's telling you a little bit more. Now, I've got them on your handout so you can actually see them and understand and recognize them and know what to do with them. Okay. But after we come up with the star position, we want to look at the next as a harami. Now, haramis, I put a lot of value on. A harami, or harami in Japanese, means pregnant. A harami is a candlestick where the current candle, including its wicks, is fully contained within the body of the previous candle. In other words, just like a pregnant person, a pregnant woman, a pregnant animal, the entire body of the newborn is contained within the body of the parent. Now, you can have a bullish candle and then a bearish candle, or you can have a bearish and a bearish candle. My rule of thumb says that the baby candle must be the opposite of the mother candle. And doesn't matter whether it's the lower portion of the body, the upper portion of the body, it just must be fully contained within. Doesn't matter if it's a small candle. It could have been a candle that was this long. Okay. As long as all the legs and hands are inside the body of the parent. And harami is a two-session reversal pattern. It's the first time we're starting to talk about something a little bit more that involves more than one candlestick also. A harami is the most common candlestick pattern you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitations. A harami is a two-session reversal pattern. It's made up of two candlesticks that implies that the price is about to turn. So as you can see here, the body of the small black candle is completely within the confines of the previous white candle. Now, I'll be blunt with you. A harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. This is one of the reasons I say it must be the opposite color. We want to make it more and more reliable by defining the rules much tighter. Now, the single candle, the small candle, does not necessarily mean a strong reversal is coming. Often with a Harami pattern, we'll go into several days of congestion. But be aware of Haramis and watch for them and what they're telling you. Look for them in relationship to the trend. So what have we learned so far? We talked about building a candlestick on a chart. We've understood and reading a candlestick, the explanation of the size and shapes, the formation, the position. We've talked about dojis, haramis, tops and shadows, bulls and bears, hammers and a hanging man. That's a lot of stuff we've talked about in the last 20, 25 minutes. Now, it's time to learn also about multi-candlestick patterns. Because as I told you, it's a lot more than just reds and greens on a chart. Now, the chart that I'm popping up in front of you, I didn't make up. I found it on the internet. But it's standard. Okay. The thing that's unique about whoever made this up, they named them Lonesome Cowboys, 2 for Tango, 3 Musketeers. I call them singles, doubles, and trios. The singles are single candlestick patterns. We talked about the Marabuzu, the spinning top, the doji, the hammer, the hanging man, the inverted hammer, the shooting star. They are all single candles. So they tell you a little bit of something, but single candles pop up all the time. When we come to 2 candles in relationship to each other, they start telling us a little bit more because they happen less often and they're telling us more about the markets. And then we come to the trios or the threes, and they're very, very important. Now, some of them are much more complicated, like morning stars and evening stars. 3 inside out and 3 inside down are very complicated to see. But I'm going to show you in a minute easy ways to locate these. We also have some very popular ones that you hear about all the time: bullish engulfing and bearish engulfing. So I've given it again, they are on your number of candles explained and your top level candlestick patterns. Because you've got the 16 top levels and the 16 second sets of candles. Now, bullish engulfing and bearish engulfing are a pair of candles that indicate that an imbalance is appearing in the market. So again, we need to look at them in relationship to the current trend. So when we get a bullish engulfing candle, so in other words, it's not complicated. It's when it's almost the opposite of a Harami, but we're not looking, we can include wicks. So it's when the current candle fully engulfs the previous candle within its overall scope, not just within its body, and it's of the opposite color. So in other words, the previous candle showed the bears were still in control and pushed the price down. The next candle shows you the bulls took over control and not only exceeded what the bears did in the prior session, but far exceeded it. When that appears also in a trend, so here we had a downtrend. The bears should have been in control. All of a sudden, we see that the bulls are taking control. That's at least telling us that this trend is over. It's telling us also that we're going to go into an upward trend, but it can't tell us exactly when, because we might go into a period of consolidation before the bulls make their final move up. But it's telling us that that downtrend has ended. The exact opposite appears when we get the bearish engulfing after an uptrend. So we could go into some sideways congestion while the bears get their feet wet and get ready, but that uptrend that it had been trading in is expired. Now we have bullish and bearish tweezers. They are a little bit weird. They are 2 candles of equal shape, of opposite color, with the same size shadows, and they look like a pair of tweezers. When they appear in a downtrend, it's telling you that trend is over. When they appear in an uptrend, it's telling you that trend is over. But to get the exact formation rarely happens. Now, from there we move over to triples, morning stars and evening stars. And they're complex little candles. Again, they're in your handouts. It would take me a half hour just to explain them all to you. So you look at them in the picture. Okay. But again, they are very, very strong reversal patterns. So to summarize, in a morning star, the first red candle during an ongoing downtrend, or we get a long red candle and ongoing, this candle represents strong bearish sentiment. So we're in a downtrend, the bears are in control. Then we get a second candle, which is a very short body candle that can either be red and green with long wicks. That's telling we moved into a period of indecisiveness. And the third candle will be a green candle, which is the opposite color, which is more than half in length of the first red candle. This candle represents a comparatively strong change in sentiment towards the upside. And why is it named Morningstar? The middle candle with the short body and the long wicks look like a star. Okay. Evening star is the exact opposite and appears at the end of a uptrend. So there, the first candle is a long green candle because it was part of an uptrend. The uptrend's continuing. The bulls are still in control. Then we get a candle of indecisiveness, and then we get the third, which is the opposite color candle, and it's half the length of the first green candle in that pattern. Then we come to two very dependable candles that you should always bet the bank on, and these are called 3 white soldiers and 3 black crows. Okay, in old charts, we had the black and white candles. Today, we could call them red and green, but this is what they're called. So 3 white soldiers could be 3 green soldiers today. Okay. But the pattern is all about a complete rout of the bears who had forced the market down to unrealistic levels. The bulls launched a massive offensive that session, and session after session for 3 sessions feed on its own momentum, disseminating the bears. So when you get the 3 white soldiers in a downtrend, that trend is over and we're moving into a very strong uptrend. 3 black crows could be 3 red crows. Okay. And it's the exact opposite of the explanation. Now, 3 inside up and 3 inside down are like the morning and evening star. They're a little bit more complex because you have to know exact patterns of the candles. Okay. But now that I've got you totally confused and you're saying, oh, this is too complicated, I got to remember too much, I'll never find this stuff on the charts. You're saying, stop it, I'm too confused with all these funny names and shapes, can't remember any of this stuff. Do I want to spend all this time locating all these on the chart? How am I going to do this? Well, if you remember, it's all about observation and market sentiment. Each candle of a candlestick chart is a reflection of the market sentiment. It's not just the standard patterns, but with keen observation, you can master the art of trading by looking at the charts without ever remembering the names or the patterns. There are many ways to trade Japanese candlesticks. The best is in combination with other indicators such as pivot points and support and resistance. You can trade with candles only. I will give you some guidelines and set some rules that I follow in another class. But the fact is, you want to learn how you can recognize these quickly and efficiently so you can incorporate them into your trader. And that's the scary part. Because there's so many patterns, and like I said, it all depends on where they're appearing and what they're trying to tell you, that a lot of people just deal with the reds and greens, which is a very bad way to go. So let's go over it. I'm going to show you some easy ways to incorporate this into your trading. So let me pop up some charts here for you. Okay. In front of you, we have a current chart on Japanese candlesticks for gold. Okay. Now, fact is, you're looking at a lot of candles and they're trying to tell you something. Well, off the bat, it's pretty easy to recognize what do we have right there? 3 black crows. And I told you this little uptrend was well over, was moving into a hardcore downtrend. And look at that. You could have really capitalized on something from 1240 all the way down here to 1228. You could have picked up $12 on gold, no problems at all. But that's very rare that that happens. And 3 black sold and 3 white crows, when they appear on charts, are pretty easy to see. There may be important candlesticks, but they're very easy to notice. But now you're saying, how do I use this in my everyday trading? How do I recognize these? How do I find them? Well, the fact is today's charts have made life easy. Like right now we're looking at TradingView. And if you go to TradingView and you go up under indicators and go under scripts, you just have to find them down here, chart patterns identified. Okay. I already put it up here and I just hit it. So I'm going to pop on here. And look at that. It identified all of those candlesticks. But now we're more confused than we were before because look at all these. Can't possibly figure out what they all mean. Not that you don't know what the patterns are. There's just too many on the charts happening all the time. So here we could go up to format and then start picking out only the patterns we want to see, clicking them off on the boxes, picking the ones we think important, figuring out the colors, how we want to note them on the chart, and set up our own little system. So you can only have the important ones. You can only have haramis if you only trade haramis. You can set them all up for you and decide how you want them. And once you set them up to save them, it'll do it. It's automatic. So that's one way we can easily incorporate them into our charts. But that means you got to be trading on TradingView or set them up with the chart system you're using and get them ready. The other way is investing.com has given us a pretty nice tool. If you go to investing.com and simply click on any asset and then go under technical, click on candlestick patterns, okay, set our chart times, it's going to drop those patterns when they're right on your charts that are there. So it's going to put a P right on your chart. And if you, you just roll your arrow over, it's going to tell you when it happened, what it did, and everything. Or it also puts it for that asset, for the euro US dollar. We can see in a 30-minute time frame, we just got a breakaway bullish flat pattern. It's a completed pattern. It was over the last 2 candles, and it's a medium important candle. But if we click on the line and open it up, it's going to give us all the information we need. We can then go right over to whatever chart you're using and drop and locate that really quickly. We can see that we had the 3 black crows on the hourly chart we just looked at. Oh, this is in euro. We were looking at gold before. We had 3 black crows 17 bars ago in a half-hour chart. In a 1-hour chart, we just had them 7 bars ago. Okay, and so forth. Now we can customize this by looking at the time frames we want to look at our charts, what patterns we want to look at, and what reliable levels we want to look at, and just simply apply it, and it's going to give it to us. Well, that means today we can add candlesticks right under our chart pretty easily. So all you have to do is, okay, okay, go look for the breakaway bullish pattern and a 30-minute chart in the last one. Now it's 4 candles because time passed, and you'll find it right away, and you can start trading. You didn't have to locate it; it's there. You just have to put it on your chart. The other way is if you find candlesticks under their technical analysis, you can then customize it and pick the assets you want to trade, the assets you trade, drop all the assets you want to trade in here, the reliability and the importance of the candlesticks, put them on here, and it will tell you based on the assets you picked. It'll keep everything customized for you and keep scanning the markets to tell you on the assets you picked and all the selection what you need to look at. So we can see in Bitcoin US dollar, we just had a doji bearish star, and the asset is expected to go down. In Ethereum Bitcoin, we just had a 3 falling soldiers, and there we go, and we can look at it on the charts, and then all we have to do is put it on our own charts. So these are some ways to easily incorporate candlesticks into your trading. But the first thing is mastering, understanding, and practicing not just what the candlesticks mean, but how to see how they work in a trend. Because just because you see 3 white soldiers and 3 black crows in a sideways movement doesn't mean it's going to go down or up. Okay, you need to start practicing these, looking at them, locating and dealing with them, and understanding how the markets react when you see them. Okay. Combine them with other indicators, and before you know it, you'll be able to use candlesticks on a regular basis. But it's a matter of practice. They are visual representations. They're not mathematical calculations, really. They're seeing that, seeing the relationship to price, to the candles, what the relationship are the candles around them, what the relationship is to the trend, and being able to incorporate that. So imagine it's like driving a car. When you first learned to drive, you were nervous. You watched really hard for all the stoplights, the stop signs of the car. After a while, you had it down pat, and they were just secondhand. And that's what you got to do with candlestick. You got to be ready to look for all the reactions and relationships. You don't have to sit there scared to death behind the wheel, holding the steering wheel at 10 and 2 and being so nervous that you can't relax. Once you get them down with practice, you'll be surprised how easy they are to incorporate into your everyday trading. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Thank you for supporting Alvexo and investing.com. And if you want to start, the Alvexo charts are a great charting service. You can get them by just setting up a demo account with Alvexo, and also use their scripts to add your candlesticks onto your charts. And they have all types of education material through their Alvexo Academy on how to incorporate candles into your everyday trading. So thank you very much for joining us. Have a great trading night, and thank you for supporting all of us. Good night now.